Hi everyone, Nalaka de Silva here. I'm the lead portfolio manager of ADIG and head of private market solutions here at Aberdeen. So here to just give you an update in terms of Q1. So the portfolios performed really well over Q1 from a NAV basis. We've been through a pretty interesting time over Q1 in terms of where markets have been. We've seen equities sort of rebound at the beginning of the year, sell off significantly on the back of banking concerns. And then sort of rebound again as sort of some of those concerns have alleviated. So overall, it's been a pretty bumpy month or quarter in terms of markets. But in terms of the portfolio and how it's positioned, we're still positioned very defensively in the context of the portfolio. There's three main areas that we're focused on: the sort of defensive cash flows that we can have, provide resilience to the portfolio. There's the diversifying assets in the portfolio that will give us sort of resilience from economic sensitivity from a macro standpoint, and then finally sort of the growth elements in the portfolio, which will provide extra growth over the long term on the private equity side. We've been really pleased by performance in Q1 for the trust, given the backdrop of conditions we've described, having kind of choppy markets to deal with. The trust delivered a positive 1.32% return in aggregate. Now, that was broken up into the four main categories that we invest across. In terms of negative areas of the portfolio, as you can imagine, the listed equities market was quite choppy, and so that was down 0.26%. So not a huge amount, but still sort of slightly negative for the quarter. And we had some FX gains and losses that were netted off at negatives at 0.2%. But now that was offset on the positive side by our fixed income portfolio and credit portfolio. Primarily, that was driven by the emerging market bonds exposure in the portfolio, which delivered both income and capital gains at 1.2% positive portfolio performance. And then the private markets portfolio had a mixed set of results within itself, but net positive overall. In terms of infrastructure, we had some discount rate expansion because of valuations coming through and the rates environment changing. So small amount of negative contribution on that perspective. Offset by a number of sales on the private equity side and income that was generated through the portfolio, both on the infrastructure side and the private equity side. So overall, that delivered a positive 6.2% performance increase. There was a bit of good news in the portfolio from litigation finance, where Burford Opportunity investment in their litigation finance portfolio had a positive result in one of the major cases they were working for, and that resulted in the value of that asset being written up over the course of the quarter as well. So overall, really pleased in terms of the income generation in the portfolio and a very stable capital growth profile that we received over the quarter. Key changes for the portfolio, I'd say, were fairly minimal over the quarter. I think, as we described, we'd positioned ADIG kind of at the back end of Q4 to be quite defensive. The majority of our assets are in I guess, less economically sensitive parts of the market. A higher allocation to cash and defensive assets and fixed income and credit. So roughly about 65% of the portfolio is in very defensive, high income yielding, high capital stability type investments, ranging from sort of cash all the way to infrastructure assets. And so at 65% of the portfolio in that position, we haven't really made a lot of changes. We've just been harvesting the yield that came off the portfolio, which we'll dividend out. Now, the only sort of movement that we're making, and it's a gradual movement, is really sort of looking at the equities portfolio. And we talked about sort of growth in Asia and China reopening, and we've taken some of our equities exposure to Asia now and taking some China exposure on the global equities front. So we'll see a little bit of rotation in the portfolio through the course of the year as we sort of position for growth. But in the current positioning, we think we're pretty comfortable with where the portfolio is, with no really any major changes, thankfully, and hopefully some strong results through the back end of the year. There's two really interesting assets that we've recently exited in the portfolio. It's probably worth talking about them. They're probably at both ends of the spectrum, which is quite interesting within the portfolio. As you know, it's a multi-asset portfolio that spans a broad range of asset classes. So on the infrastructure side, back in December, we were participating in a sale process of what was called the I77 Interstate, which is an infrastructure asset, a toll road that's based in North Carolina in the United States. It's one of the main arterial routes into Charlotte, North Carolina. And that was developed and built over the course of 3 years through the COVID period. it was closed. However, the cash flows were contracted. When the markets reopened and people were starting to travel again, we actually had a really significant increase in the revenues that were generated off those traffic flows and using the I77. And we received an offer for that particular asset via abrdn Infrastructure Partners, a vehicle that we invested in through the US. And we chose to exit that in Q1. So a fantastic transaction for ADIG. We delivered roughly sort of a 3.5 times money multiple in terms of money invested. So we trebled our investment at the time of exit. That equated to roughly around a sort of a 60% return on investment, which is, for the time in terms of IRR, that was a great result for the portfolio. And once again, sort of demonstrating, sort of the resilience of these types of investments in the portfolio and being able to exit at strong pricing and being able to reallocate the capital. So the I77 toll road was a really great example, pretty interesting asset in of itself, but a fantastic investment return. On the other end of the spectrum, we had a really interesting investment that got sold, which was called Sticks N Sushi, which is, for those that live in London, there's a number of chains of this food franchise where it was invested through Marge, one of our Nordic private equity managers, where they have a business model of going in essentially food and beverage specialization. They've been able to take this brand and expand it across Europe. There's a number of outlets now in Europe and the UK. There's a new style of essentially yakitori brought in a kind of a fresh sort of manner, which is proving really popular with customers. And that investment was invested over the last 3 or 4 years. It's gone through a huge amount of resilience going through the COVID period, given the nature of what we've been through from the food and beverage market. And that's delivered a 16% return on investment for us when we sold the asset through that program. So once again, very different type of assets, completely different sector, different market, providing different characteristics to the portfolio around growth, but very strong investment potential. Through the period of developing the franchise, making sure it's marketed well, building out the business model, keeping the resilience going, and then being exited in the portfolio. We're pretty cautious in our outlook at the moment. I think there's kind of 3 main levels that we're focused at. One is kind of the longer term macro environment and where that gets to. As we discussed earlier, sort of the rates environment is uncertain. So we're looking at where inflation gets to. Inflation is still continuing to be a key topic. Our central banks are seeking to combat that through interest rate rising. That's having unintended consequences. We've been through a number of quite significant sort of recapitalization of banks as a result of interest rate environments and treasury management. That's going to have a knock-on effect to the markets. On the positive side, we're seeing China reopening, and we're hoping that domestic demand ultimately and sort of growth in the region will offset sort of developed market weakness sort of towards the back end of the year, as if we move into a potential recession or recessionary environment as a result of the macro situation. And I think that's how we're sort of positioning at the top level. In terms of themes, that we're still very much focused on long-term drivers of value. So ADIG has 3 main themes that it runs at the asset level, which is around technology, demography, and sustainability. Technology broadly around investments around digitization, making sure companies are utilizing technology well to drive earnings, operational efficiencies, which we can then extract earnings out of and sell into the future. Demography really plays into the infrastructure portfolio, looking at sort of changing societies, the requirement of essential infrastructure, both in developed and emerging economies, and we're playing that through the portfolio in a number of assets. And sustainability, we've had a very strong focus on looking at renewable energy, particularly on the infrastructure side, and then assets that are making sort of good use of their resources and resource scarcity, and we think that'll be a theme that we need to manage going forward as well. So all of these things, I think, are going to be long-term drivers of value, and ADIG is playing its part in providing capital to those organizations and projects that are delivering value through those means. And ultimately, as the portfolio matures in some of those projects and we exit them, we'll generate very strong returns off the back of those themes.